They said it was going to zero. They called it the used car bubble. Back in 2022, Wall Street left Carvana for dead. But guess what? They were wrong. Carvana didn't just survive, it just punched its ticket to the big leagues. Carvana is officially joining the S&P 500. The stock is already up over 8,000% from the lows. But if you think the show is over, you need to see the data I'm about to show you. There is a multi-billion-dollar forced buying event scheduled for December 19th, and the short sellers, they are trapped. Let's break down the math. First, you need to understand the mechanics. When a stock joins the S&P 500, it's mandatory buying. Trillions of dollars sit in passive index funds. These funds act like robots. They don't analyze valuation, they just match the index. They have to buy Carvana. The effective date is Monday, December 22nd. But here is the key. The robots don't wait until Monday. They execute their massive buy orders on Friday, December 19th, right at the market close. How big is this order? We are estimating between 16 to 18 million shares must be bought in a single session. To put that in perspective, Carvana's average daily volume is only about 2.5 million shares. Imagine trying to force 6 days worth of buying into a single afternoon. That is a liquidity shock. Now mix in the short sellers. Carvana is still a heavily hated stock. Look at this short interest data. Even at these all-time highs, there are millions of shares sold short. These people are betting the stock goes down, but now they are staring at the S&P 500 inclusion. They know the passive buying wave is coming on the 19th. This setup reminds everyone of Tesla in late 2020. Before it officially joined the S&P, the stock went parabolic because everyone, shorts covering, traders front-running, was buying at the same time. If the shorts panic and rush to cover, while retail traders jump in for the FOMO, that creates the perfect squeeze trifecta leading up to Friday. But wait, before you go all in, you must understand the risk. There is a classic pattern called the inclusion pop and drop. Smart money, hedge funds, and active traders bought Carvana weeks ago. They are sitting on huge profits. They are waiting for that liquidity event on December 19th to sell their shares. Who are they selling to? The passive robot funds that have to buy at any price. We've seen this play out many times. Look at a stock like SMCI around its inclusion. Often the price peaks right when the inclusion happens, because the news is finally out and the smart money exits. If you buy right at the top on inclusion day, you are literally buying the bags from the smart money. So here is the verdict. The squeeze potential leading up to Friday, December 19th is very real due to the sheer volume of forced buying colliding with short sellers. But be extremely cautious holding through the event into the following week. The easy money is usually made before the official date, not after. I will be watching the volume closely next Friday. What's your call? Is Carvana heading to $500 or crashing back down? Let me know in the comments below. If you found this data analysis helpful, please hit the like button and subscribe. I'll see you in the next video.